Welcome to Allodium's Introduction to Investing presentation. I'm Eric Hutchins, our President and Chief Investment Officer. We're happy that you have joined us for today's session. Quick disclaimer, this is an educational presentation about the basics of investing. It is not intended to provide tax or legal advice or any specific investment recommendations. The Allodium Investment Committee has asked two of its members to lead today's session. Saul Bauman and Derek Van Callaghan are investment consultants with more than 10 years of experience in financial services. We have budgeted 40 minutes for our formal presentation. At the end of the presentation, we have set aside 20 minutes to answer questions submitted by the audience. We encourage you to submit questions during the presentation using the Q&A message box in the Zoom application. I will now turn things over to Saul, who will go over the outline of what we're going to cover today.
Welcome. We're excited to share our Introduction to Investing presentation with you. In developing this presentation, we thought about what we would have liked to have known when we first started investing. These are some of the topics we'll discuss today: basic concepts of investing, tools of investing and types of investment accounts, investment principles, and pitfalls to avoid. We should first discuss why invest. Investors are typically investing to reach a goal, such as financial independence or retirement. Making your money work for you is a key part of the process in reaching these goals. While there are risks to investing, there are also risks in not investing. The reason for this, of course, is inflation. If you were to hold all of your money in cash, you'd lose spending power over time. We'll next discuss the power of compound returns. Compound returns occur when growth on investments is reinvested. In this example, we look at a one-time $10,000 investment growing at 8% a year. You see that the first year it grows $800, which is then added to the original $10,000. The 8% return the second year increases to $860. Over time, this really adds up. In year 40, the $10,000 has grown to over $200,000 and is generating over $16,000 a year. I'll let you read the following question. Let's look at the results. The first investor wins. Even though the investor who started at age 25 invested only 1/3 as much as investor 2, she ends up with the most money because she started early. This is the power of compound returns over a long period of time. As we saw in the last example, it's hard to estimate the effects of compound returns. The rule of 72 is a handy technique to estimate future growth at a specific annual growth rate. To estimate how long it will take for an investment to double, divide 72 by the annual return percentage. For instance, at 9%, an investment will double in about 8 years. At 6%, it will take about 12 years to double. Stocks and bonds are two of the most common types of investments and are what we'll focus on today. When you buy a stock, you're buying a piece of a company. You benefit when the company grows in value and/or when the company distributes cash to stock owners called dividends. When you buy a bond, you're lending money for a certain amount of time in order to receive a specified amount of money back each year. At the end of the time period, you get your original amount back that you lent. Let's look at an example. Imagine you buy a 3-year bond with 3% yield for $1,000. At the end of year 1, you receive $30. At the end of year 2, you receive another $30. At the end of year 3, you receive the last $30 and the original $1,000 that you lent. You may have heard that bond values go up when interest rates go down and vice versa. Let's look at an example of why this occurs. So imagine you purchased the bond we just talked about, $1,000 bond, 3 years, 3%, generating $30 a year. Now let's say that interest rates go down and someone now, if they want to buy a $1,000 bond, instead of 3%, it's only offering a 1% yield or $10 a year. Well, your bond looks pretty good now and it's gone up in value. People are going to be willing to pay you more than $1,000 for your bond. In order to potentially have higher gains, you need to take on greater risk. This chart shows the growth of $1 invested in various types of investments. The lowest line is inflation, showing that something costing $1 in 1926 cost $17 in 2022. The next line up in red is US government treasury bills, a type of short-term bond. You see that they have steady long-term growth, but they barely beat inflation. At the top of the chart is US small company stocks. You can see that they have the highest growth, but it's been a choppy ride. Over long periods of time, the value has gone up, but they've lost money over various periods as well. The large ups and downs are referred to as volatility. You can see that the higher growth investments have increasing levels of volatility. This brings up the question of what is the right mix of risk, reward, and volatility. This chart shows the percentage of times the S&P 500, made up of US large company stocks, are positive over different periods of time. On the left, if you look at just one-day periods, there's about a 50-50 chance that the S&P 500 will be either up or down. However, as you go to the right and look at longer periods, the higher the chance it will end up with a positive return. If you were buying a house in a week, it would be pretty foolish to put the house money in the S&P 500 with a 43% chance it would lose value. However, the probability looks quite different if we're investing for retirement over 15 years from now. Let's now shift our attention to the concept of diversification. Let's imagine that you put all of your money in one company's stock. This company may do great and make you a lot of money, but it may also lose money for a number of reasons. Perhaps it doesn't manage its business well, falls out of favor with investors, or faces lawsuits. One way to lessen this risk is by owning many different companies and different types of companies. This map shows the percentages of each country's share of global investable assets. In other words, if you were to invest in every public company in the world, 59% of your money would invest in US companies. This means that 41% of investment opportunity is overseas. Now, I realize that this chart's really hard to see, so I'm going to explain what we're looking at. Each colored square represents a different country. The columns represent 20 years of investment returns, ending on the right 2022. And the countries are ordered with the highest returning countries at the top for each year and the lowest returning countries at the bottom. Now, about halfway over is 2014, and the US is the blue square at the top. And over this 20-year period, the US was only the top performing country one time. Interestingly, Austria was the top country 3 different years. Now, one takeaway from this is that if you did not invest globally over this period, you may have missed out on some growth opportunities outside of the US. Another benefit of diversification is that it can smooth out returns over time. By having investments that act differently, the result is a less volatile overall investment experience. I'll now turn it over to Derek to discuss some of the logistics of investing.
Thanks, Saul. Saul covered the basics of investing, but now we'll talk about how you can build a diversified portfolio. The US alone has over 3,000 stocks, and there are many more globally. Fortunately, it is not necessary to pick and buy hundreds of individual stocks in order to create a diversified portfolio. What many people do is instead purchase mutual funds or ETFs, which are short for electronically traded funds. Mutual funds and ETFs are investments that contain groups of stocks and/or bonds. In the fund structure format, investors pool their money together, and the fund manager then chooses what securities to invest in. This gives individual investors access to a diversified portfolio of securities with relatively small dollar amounts. As the stocks or bonds in the fund generate returns via dividends, interest, and capital appreciation, those returns are then passed on to the investors of the fund. When it comes to investing in funds, there are two main types of investment strategies: passive versus active. Active investing is the conventional form of investment management. The fund manager relies on forecasting and market timing to choose securities that they believe are undervalued. This has been the dominant type of investment strategy up until about 10 to 15 years ago. Fund managers charge higher fees for active management, and investors in actively managed funds do have the opportunity to beat the market. Passive investing is a popular investment strategy that is more cost and tax efficient than active management. Passive investing is often called indexing. Index investment management is a strategy that is based on tracking a commercially developed index, for example, say the S&P 500. What an index fund manager does is buy all the securities to mimic that index. This strategy does not have the opportunity to outperform the index, but it won't underperform as well. Since managers are tasked with just tracking an index, this is the cheapest investment management approach. Mutual funds and ETFs all have costs that are called expense ratios. These are expressed as a percentage, and it is a fee that the fund manager charges to run the fund. Typical expense ratios can range from 0.03% for passively managed funds all the way up to 1.5% or more for actively managed funds. So now we know that we can easily diversify portfolios using funds, and we can choose between active or passive managers. But you may be wondering, what types of accounts can hold investment funds? One of the more popular investing accounts are called tax-deferred accounts, which are individual retirement accounts, also known as IRAs, and 401ks. These accounts give you a tax deduction for contributions, which means it lowers your current taxable income and saves you on taxes now. And the assets then grow tax deferred. The kicker here is that withdrawals from the accounts are included as taxable income, so they are not as tax efficient during the spend down phase in retirement. Tax-free accounts are Roth IRAs or Roth 401ks. You do not receive a tax deduction on contributions, so there's no immediate tax benefit, but the assets do grow tax-free, and withdrawals are thus tax-free as well, so long as you adhere to certain IRS guidelines. Tax-free accounts are the most tax-efficient accounts during the spend down phase. Taxable accounts are individual or joint brokerage accounts. You do not receive any tax preference for contributions or withdrawals, and you must pay taxes on capital gains and income generated from the account on an annual basis. These accounts do not have any penalties or special rules regarding contributions or withdrawals like tax deferred or tax free accounts do, but they do have limited tax benefits. Even most beginner investors know that to consistently make money in the market, you need to buy low and sell high. This can be very hard to do if you do not have an asset allocation target that you can stick to through every market environment. A strategy called rebalancing is a disciplined way investors can buy low and sell high in their investment portfolio. Rebalancing is the process of selling from the best performing asset classes while buying into asset classes that have not performed as well. By doing this consistently, investors maintain the target asset allocation of their portfolio, and they can use the market gyrations to their advantage to enhance the portfolio's return while also controlling investment risk. A good example of rebalancing would be to think back to the COVID crisis when it started back in March of 2020. The US stock market dropped nearly 30% in a 3-week time span, whereas bonds held their value relatively well and were even slightly positive during that same time frame. If you had a diversified portfolio of stocks and bonds and adhered to a rebalancing policy, you could have sold bonds at a gain and then reinvested those proceeds in the stocks to take advantage of the lower stock market prices. So we just went over the things that go into building a diversified portfolio and becoming a disciplined, tax-savvy investor. Now we're going to discuss common mistakes that investors make throughout their investing careers. One of the biggest mistakes an investor can make is to let their emotions get in the way when making investment decisions. The biggest feature of the stock market is that it's always going to move up and down. On any given trading day, there's basically a 50% chance whether or not the market is going to end the day higher than where it started. Every 4 years on average, the stock market declines more than 20%. Seeing your portfolio fall double digits is unsettling even to the most seasoned investors. Oftentimes, people can't handle watching their wealth deteriorate, and they make an emotional decision to sell their stocks and then move to cash. This is one of the worst things an investor can do because you're locking in investment losses, and then it's hard to find a comfortable time to get back into the market. Whenever we experience a prolonged decline in the stock market, I always try to remember the famous quote from Warren Buffett: "Be fearful when others are greedy, and be greedy when others are fearful." What he is saying here is that when we do have market declines, investors can take advantage by putting more money into the market and buying stocks at lower prices, which should then boost long-term expected returns moving forward. There are some investors out there who have overconfidence bias and think that they can predict or time the market. Oftentimes, investors will pull money out of the market or put more money into the market just based on how they think the market is going to react to a certain event. A recent example of this was the debt ceiling showdown in Washington that occurred at the beginning of this month. On CNBC, leading up to the June 2nd deadline, there were talking heads being interviewed daily, telling people how they should position their portfolios based on all different outcomes of the debt deal. Trying to predict how the market is going to react to certain events is a fool's game that can drive a person insane. I really like this chart on the screen because it shows many of the major events that have happened since 1970, which could have spooked an investor from investing in the stock market. $1 invested in the market being the MSCI World Index, which is essentially the global stock market, in 1970 would be worth nearly $100 today. And that's even with multiple 20% crashes during that same time frame. Making reactionary decisions to try and time the market often does not work out in one's favor. When the stock market rallies higher from a market bottom, it often does so quickly and in short bursts. Missing the best few days of stock market performance can be detrimental to long-term returns. This chart here shows the performance of the S&P 500 index from 1990 through 2022. If you were to be invested during that entire time period, you would have realized a 9.75% annual return. Now, if you look at by just missing the 5 best days of trading during that time frame, the return drops all the way down to 8.23% annually. And that's the difference of about $8,000 over the course of the 32 years. It can certainly pay to stay invested during every market environment. Another common mistake that investors make is holding too much of one individual stock, also known as overconcentration. Many people who work for large, publicly traded companies choose to own the stock of their employer in their own personal portfolios. This can lead to an outsized risk in the portfolio, since individual stocks are much riskier than owning the entire stock market as a whole. One personal example that I'll never forget was when I met with a prospect back in 2016 who worked for GE, or General Electric. He wanted to retire within the next year, so we took a look at his 401k allocation and noticed that 75% of his 401k plan was invested in GE stock. So we asked him why this was, and he simply said, "Because it's the best performer in my 401k. Why wouldn't I want to be heavily invested in it?" We told him that it would be a prudent strategy to diversify away from GE stock and into more diversified funds, so the portfolio wasn't concentrated with the risk of that single stock holding. Now, as you can see from this chart here, GE stock actually peaked in 2016 and then proceeded to collapse by almost 70% over the next 2 years. That prospect never ended up becoming a client, but I do always think back to our meeting and wonder if he did follow through with our recommendation. If not, his retirement would have been in serious jeopardy. Many investors waste time and energy trying to beat the market. More enlightened investors learn to relax and focus on both the things that matter and the things that they can control. They let the markets work for them. Some examples of things that do not matter are hot stock tips, your friend's investment performance, or what the financial media is saying. A few examples of things that are out of your control would be the economy, interest rates, politics, and the overall performance of the stock market. Good investors have learned to not focus on any of these things and instead focus on things that matter and that they are in control of, like your own personal financial goals and aspirations, your own investment decisions, and your own personal savings rate. In summary, a tried and true way of becoming a successful investor is to avoid emotional decision-making and focus on what you can control. The great news is that there's never been a better time to be an individual investor than right now. Costs have really come down across the investment industry, and there are so many investment products out there that an individual investor can build a globally diversified portfolio that costs less than 0.1% per year. But as Warren Buffett said, investing is simple, but it's not easy. Just because anyone can build a globally diversified portfolio these days does not mean that they have the capability to stick to their investment plan during a volatile market. It's crucial that investors create their own investment plan that fits their own goals and personal risk tolerance. Diversify your investment portfolio with assets that move in different directions, such as stocks, bonds, and alternative investments like real estate and commodities to reduce the risk. The benefits of a diversified portfolio are enhanced when you can stick to a disciplined rebalancing strategy. To recap, we started by discussing the basic concepts of investing that set the foundation for every investor. We then talked about how an investor can begin investing. For example, what accounts to use and the advantages of using mutual funds and ETFs over individual securities. We finished the presentation going over the investment principles that make up a good investor and brought to light some of the more common pitfalls that investors should try to avoid. We hope you enjoyed our introduction to investing presentation today, and we wish you all the best as you embark on your own personal investing endeavors.
Great. The first question is, what is the impact of inflation on investments? Derek, I'll let you take that one.
Yeah, thanks, Saul. And inflation it's certainly been a hot topic over the past year. Probably one of the biggest topics we've talked about with clients since probably the middle of 2022. And that's really because we saw the highest inflation last year that we haven't seen since the 70s and early 80s. And inflation is when prices in the economy increase. And when you think about it historically, the inflation rate has averaged about 3% per year. And leading up to last year, over the last 10 years, it was actually closer to about 2%. So we've been in a really low inflationary environment in the last decade. And then last year, the inflation rate peaked at 9% back in June. So it was about triple the historical average. And it was inflation rates that really most of us haven't even seen in our lifetimes. Now, inflation is dangerous because it erodes the purchasing power of money over time. So the same amount of money that will buy you fewer goods and services in the future as prices rise. So if your investments aren't growing at least the rate of inflation, then the real value of your money is actually going to decrease. Now, historically, equities and real assets such as like real estate and commodities have shown the ability to provide a pretty good hedge against inflation and typically do well in inflationary environments like we saw last year. And when you think about this, it kind of makes sense intuitively, right? Because companies can simply increase their prices so that their earnings keep pace with inflation, which is, what companies have been doing over the past 12 to 18 months. And then when you think about real assets like commodities and real estate, they tend to appreciate in value over time, which helps maintain that purchasing power. Commodities and real estate, their prices just like, other goods in the economy, and they'll tend to increase with the price of inflation.
Great.
Sorry, go ahead, Saul.
I see the question. I like the idea of rebalancing, but how do I do it? So I can take that one. The first step is you need to have an investment target. So for simplicity, let's say you have two investments, a stock fund and a bond fund, and say you want 70% stocks and 30% bonds. So to rebalance, really what you're doing is you're monitoring the actual percentages and bringing them back to your target when they drift. So if stocks do really well, say they're now at 80%, you'll sell some, which is selling high, to return to your target of 70%. And with the proceeds, you'll buy bonds. So you're buying low to bring them back to 30%. Now, I'll mention that if you're doing this within a retirement account, many retirement accounts have the option to rebalance on their own periodically. It's usually a setting. So it's worth checking to see if that's an option in your accounts.
Yeah, that's a great answer, Saul. And I know we talked a lot about rebalancing in the presentation, and it just goes back to that simple concept of buy low and sell high. But like you just mentioned, you really need that target asset allocation to figure out, what's higher than target, what's lower than target. Otherwise, if you're going on a whim and you don't have those asset allocation targets, it's a good way to get emotions involved with investing. And as we mentioned before, we obviously do not want that.
Absolutely. All right, another question. What is the expected rate of return on different types of investments? Derek, do you want to take that?
Yeah, I could take that. That's a really common question that we get from, most prospects and clients is they always want to know, what can I achieve on my investment portfolio? And, the answer is, as it oftentimes is it depends. But, when we think back to our slides on risk versus return, right? The riskier the investment means the higher the expected return. We need to get compensated for taking on risk. Stocks are one of the riskier investments that you can make, so they should have higher returns because they are more risky. And when we look back historically, the long-term average rate of return for the S&P 500, which is a good proxy for the US stock market, has been about 9.5% annually going back 30 years. So just shy of about 10% per year. Now, if we contrast that with bonds, which are less risky and thus have less return potential, we see a little bit different story. So over those last 30 years, when we take like the US total bond market, it's averaged at about 4.3% per year. So, less than half of the return of the US stock market. Now, that's also with a lot less volatility, meaning there's going to be a lot more ups and downs throughout the year than if you're investing in all stocks. Now, if we think about putting a balanced, diversified portfolio of stocks and bonds together, that would have averaged anywhere between 6 and 8% annually. And that's depending on, the specific stock to bond mix and, whether you have high yield bonds in the portfolio or just investment grade, or if you have international emerging market stocks versus, just US stocks. So there's a lot of factors that go into it, but historically or in the long term, stock market averages close to 10% a year, and bonds are a little bit less than half that. And, talking about past performance, it's important to note that these past results of performance do not guarantee future performance. There are a lot of factors that go into investment performance, things like interest rates, stock market valuations, where we're at in the current economic cycle, geopolitics that are going on in the world. And there's so much more that influence these types of security prices. And remember, these are long-term average returns over the course of 30 years. And in any given year, the performance of the stock or bond market, could be much greater or much lower than average. Oftentimes, it's pretty rare to see the stock and bond market actually hit their average. It's either going to be, much higher or much below, but over time, things start to smooth out a little bit.
Great. We have a question on target date funds, and are they a good way to invest? All right. So in retirement plans, you'll oftentimes see investment options with a year on them. So this year corresponds to the year someone is planning on retiring. So if you think back to the slide on the S&P 500 performance over different periods, you may remember, as Derek said, that on any day, the S&P 500 could be up or down about a 50-50 chance. But over a 15-year period, historically, it's always been up. So the idea is that the longer the time you have to invest, you may be able to take on more risk for a greater chance of higher returns. So what target date funds usually do is hold a mix of stocks and bonds. And if you're a long ways away from that date, they hold generally a higher percentage of stocks. And over time, as you get closer to that date, the stocks start to decrease and the bond holdings increase, thus lowering the volatility. So we think that makes a lot of sense. Another thing we like is that these funds typically have a good global diversification mix, and they also rebalance periodically on their own. Now, that being said, everyone's goals and situations are different. So it's not possible to recommend that a chosen allocation mix is appropriate for everyone who wants to retire on a specific year.
Yeah, it's a great answer, Saul.
Great. And this is another question. What is the minimum amount you should rebalance 1 time a year, 2 times a year? How often should you review and adjust a investment portfolio? Derek, do you want to?
Yeah, I can take that one, Saul. Just kind of dovetailing off of your answer there about the target date funds. And, again, the answer, there really is no right or wrong answer to this question. It really comes down to personal preference and whatever you're comfortable with. So, I can say personally for my portfolio, when I was younger, I was checking it almost every day, and I was trying to make these wacky trades and really try to beat the market. And then, after having a handful of stocks that you lose quite a bit of money on, or what was quite a bit of money for me back in the day, you start to realize, like, hey, there is some truth to this thing of, just setting an asset allocation, sticking to it, being disciplined, and rebalancing. So, personally for me right now, I'm investing for retirement, which I know is going to be, at least 25 plus years away. So I really don't look at my portfolio that often right now. I've built out an asset allocation that, is similar to, how we build portfolios for our clients. And I try to stick to that, and I'll review my portfolio maybe once a quarter to see if I need to do any rebalancing. But, I'm not really getting in there looking to buy different funds or sell out of different funds. I'm comfortable with the funds that I've chosen. So it's really just looking at rebalancing. And, during times of market crisis, when the market is volatile, I might review my portfolio just to make sure I'm rebalancing and taking advantage of those lower stock market prices. Maybe be doing that a couple times a quarter then. But I try not to look at it that often. And I know some people who are contributing to 401k plans, they do invest in those target funds that you just mentioned previously. And it's really just like putting your investment portfolio on autopilot. If this is the case, you could theoretically go years without looking at your portfolio, since that target date fund manager is already going to be doing that rebalancing for you. Because we're an investment management firm, for our clients, we're reviewing their portfolios constantly. Not only are we paid to do so, but most of our clients are near or at retirement, meaning that they can't really afford to make investment mistakes that they could have, say, 15, 20 years ago, when they had plenty of time to recover before that retirement age.
Great. Thanks, Derek. I just add to that. So you can really look at rebalancing frequency a couple of ways. You can look at it a certain number of years, a certain number of times each year, say quarterly or twice a year, or you can do as Derek referenced, and that's looking for a certain amount of drift. So in the example I gave, if you're targeting 70% equities, when they reach, maybe it's 80, maybe it's 75, maybe it's 72. But if once they cross a certain threshold, that's really your trigger to rebalance. So different strategies, certainly. The important thing is that you stay disciplined and stick to a strategy.
Yeah.
All right. I see another question. How do I decide what type of investment account to use? Great question. So it's hard to really answer that without knowing someone's specific situation, but here are some thoughts. So if you're still working, many company retirement plans offer a company match. So we like to think of this as free money, and we definitely recommend investing as much as is needed to meet the full company match. Now, outside of company plans, many people consider traditional IRAs or Roth IRAs. And I know that Derek talked a bit about these, but And I'll also mention there are income limits and other things to consider. So we'll talk about this high level. But the general rule is that if you think your tax rate will go up over time, invest in a Roth. And if you think your tax rate will go lower, invest in a traditional IRA. So with a Roth, the money that you invest has been taxed already. You're using after-tax dollars, and it's been taxed at your current lower rate. And then when you take out the money later, it's tax-free. Now, if you think your tax rate is currently high and will be lower when you need the money in retirement, invest in a traditional IRA now to get the tax deduction. And then you'll pay the lower tax rate when you take the money out later. Good question.
Yeah,
All
that's a
right.
great question.
Oh, I like this one. How do I choose a reputable financial advisor or investment professional? And I'll turn that over to you, Derek.
Great. Yeah. Another very solid question. And choosing a financial advisor, it is a personal decision, and it's crucial to find someone who understands your unique financial situation and your financial goals. The first step you want to do is research the credentials and qualifications to ensure that the advisor can demonstrate that's a certain level of expertise and adherence to professional standards. The most popular designation in the financial services industry is the CFP designation, known as a Certified Financial Planner designation. This designation signals that the advisor has really a broad-based knowledge in all facets of financial planning, from insurance, estate planning, investment planning, retirement planning, and so much more. So that's really the first step, is finding someone who has those baseline of credentials and expertise. Then what you often want to do is check registrations and disciplinary records of advisors. That's very important as well. You can check the background and disciplinary history of advisors through the Securities and Exchange Commission, SEC, their website, or the Financial Industry Regulatory Authority, or FINRA, their website as well. And oftentimes, even just a quick Google of someone's name, and you can find, pretty much everything that you want as far as background goes. And then third, you really want to understand the fee structure. Inquire about the advisor's fee structure, because oftentimes the fee structure for different advisors, can be different, and it can be complex depending on, what type of advisor you want to hire. There's different advisors that may charge fees based on a percentage of assets under management. There may be hourly rates. There may be, flat retainer fees, charged quarterly, monthly, or annually. Or there could be commissions, which, historically, that was the kind of most dominant type of fee structure up until probably the 2000s or the 2010s. So you want to make sure you understand all of the costs involved and how they may impact the return on your investments. And finally, and probably most importantly, you'll want to find an advisor that you trust and that you can connect with. You can do this by asking family members, friends, or colleagues for referrals for their advisors that they trust and that they've already vetted. It's often a good idea to interview multiple advisors and really find one that is the right fit for you, that you connect with, that you trust with, and that you understand the fee structure, so you understand exactly how that advisor is being compensated. So it may sound like there's a lot that goes into it, but oftentimes it's really a gut feeling, and being able to understand the costs involved, because they can be quite tricky depending on the firm that you hire.
Great. Thanks, Derek. We have a question: which investment type has performed better over recent years, mutual funds or ETFs? So I think I'll take a stab at this. I think this could be interpreted a couple ways. So I'll answer it two ways. So one thing to note is that if we're talking about an investment that tracks an index, say the S&P 500, so when Derek talked about passive strategies, you can have either an ETF or a mutual fund that tracks an index. And, you know, if they're both tracking the index, what will affect their performance is really the fees for the individual investment. But in theory, they should perform very similarly. Now, if we're talking instead of an active investment style, so a fund manager picking the stocks, for instance, versus an index passive strategy, you know, it's really hard to say what will happen if we're looking at short time periods. Now, when we look at long time periods, what the academic research and history has shown us is that it's very hard for active managers to consistently beat an index or a benchmark. So every year, of course, a certain percentage do. But what's interesting to see is when we look at the managers that have beat the index over a certain period of time, often the next time period looks very different and they may underperform. So I hope that answered your question. And then looks like we have one more question. This is a question on the impact of prior inflation and then inflation added to that, and what is a good strategy to make sure that your investments keep pace in this type of environment that we're seeing currently. And of course, we all experience higher expenses of everything we're buying. So, Derek, would you want to speak briefly to that?
Yes, certainly. And you know, another great question. And it goes back to, you know, having a diversified portfolio that includes a risky securities that can keep pace with inflation over time. So, you know, we all know that inflation last year averaged, you know, right around 8-9%. You know, that's already built into the system here with prices. You know, it's not like I shouldn't say we're not going to, because, you know, we can't predict anything, but it's very unlikely we're going to get deflation this year where prices drop 9% back to those levels. So we're kind of we set that high watermark. And, you know, as you mentioned, stocks and bonds had a poor year last year. You know, they were down double digits. So really the real return of your portfolio, you know, instead of being down, say 10%, it was probably might be down closer to like 19 or 20% real return if you account for inflation. Now, that's only 1 year. So over the length of time, you know, we're not expecting inflation to be 9% every year. We're expecting that to come down to 3%. And oftentimes, after a poor year in the stock market, it's followed by a better than average year. You know, this year in the stock market, I think the S&P is already up close to about 15%, and we're not even halfway through the year. And inflation right now is, I think, back down to right around you know, between 4 or 5%. So everything kind of comes back to balance over in the long term, but you really need to just make sure you have a globally diversified portfolio that has an allocation to, you know, investments that, you know, can do better in an inflationary environment, like stocks, like commodities, like real estate, so that you can keep up with that over time. Because we know we're going to have years like last year where inflation might be up, portfolio might be down, and that's really a double whammy. But then on the flip side, could have years like, you know, like 2023 starting out to be, where inflation's come back down, you know, portfolios might be up. So any given year, we don't know what's going to happen, but long term, you know, globally diversified portfolio, rebalance, stay the course, and you know, things should be in your favor.
Great. Thanks, Derek. So let's see. I do not see any more questions. So at this point, we'll conclude the presentation, and we appreciate you joining us today.
Thank you, everyone.